The last few decades have trained us to believe that crises arrive without warning. One day the world looks normal, the next day the floor gives way, jobs disappear, assets fall. People ask how this could have happened so quickly. But history does not work like that. History whispers long before it screams. There is a pattern most people ignore, not because it is hidden, but because memory is short. Roughly every 18 years, the global economy stumbles in a familiar way. The details change. The headlines change. The villain of the story changes. The structure does not. In the early 70s, people blamed oil. In the early 90s, they blamed geopolitics. In the late 2000s, they blamed banks and derivatives. Those were not causes. They were symptoms. The first domino, every single time, was real estate, not homes on quiet streets. Commercial real estate, offices, shops, buildings that live and die on cash flow. When commercial property stops producing steady income, the system starts to crack. Slowly at first, then all at once. Today, something unusual is happening, and almost nobody is paying attention. The default rate on U.S. commercial real estate loans has climbed above 11%. That number matters. Not because it sounds big, but because it is the highest level seen since the last global financial crisis. At the same time, office vacancy rates in major cities are hovering around 20%. In some downtown cores, they approach 40%. Think about what that really means. Imagine owning a building that was designed to be full, every floor rented, every month, producing cash. Now imagine half of it sitting empty, lights off, elevators unused, coffee shops downstairs gone quiet. The mortgage still exists. The maintenance bills still arrive. Taxes do not pause out of sympathy. Cash flow dries up, and when cash flow dries up, leverage becomes lethal. Many people assume this is just a post-pandemic adjustment. Remote work happened. People changed habits. Cities will adapt. Some of that is true, but adaptation takes time. Debt does not wait. Commercial property loans are short. 5 years is common. 7, if you are lucky. During the pandemic years, money was cheap. Painfully cheap. Borrowers locked in rates around 2 or 3%. Banks were happy. Central banks were flooding the system with liquidity. It felt safe. It felt permanent. But cheap money is a temporary anesthetic. It masks damage. It does not heal it. Those loans are now approaching maturity. Here is the part most people miss. When a commercial loan matures, you do not just keep paying interest. You owe the entire principal. All of it. If you borrowed $100 million 5 years ago, that $100 million comes due, not gradually, all at once. Most owners cannot pay that. They never plan to. They plan to refinance. Refinancing only works if two things are true. The asset holds its value, and money is available at reasonable rates. Right now, neither condition holds. Office buildings have lost massive portions of their value, some by 30%, some by 40%, some even more. Banks no longer lend against yesterday's prices. A building once valued at $100 million might now be worth $60. The bank might lend $40. If they lend at all, at the same time, interest rates are no longer near zero. They have doubled, in some cases tripled. So the owner faces a brutal equation. They owe $100 million. They can borrow 40 or 50 at twice the interest. The gap is fatal. This is why defaults are rising, not because owners suddenly became irresponsible, but because the math stopped working. When enough owners reach that point at the same time, the problem spreads. Banks begin to feel it, not on paper, in cash. A loan that stops paying interest is not an abstract concept. It is missing income. Banks respond the only way they know how. They pull back, lending standards tighten, credit disappears. Even healthy businesses struggle to borrow. Small companies feel it first, then workers, layoffs rise, spending slows, tax revenue falls. Cities feel it next. Commercial real estate is a major source of local tax income. When values collapse, budgets follow. Public services are cut. Infrastructure projects stall. Government jobs quietly vanish. None of this happens overnight. That is what makes it dangerous. People see pieces of the puzzle. They do not see the picture. And while all of this unfolds, attention is pulled elsewhere. Stock markets fluctuate. Tech headlines dominate. Short-term noise fills the air. Meanwhile, the real pressure builds in silence. There is another layer to this story, and it may be the most misunderstood part. Central banks are preparing to change course. They talk about slowing balance sheet reductions. Some talk about future rate cuts. This creates a false sense of safety. People hear easing and think relief is coming. They assume refinancing will become easier, but short-term rates and long-term lending are not the same thing. Commercial real estate depends on long-term capital, 5-year money, 10-year money. Those rates are driven by supply and demand is exploding. As more loans mature, more borrowers rush to refinance. At the same time, banks have less appetite to lend. That imbalance pushes rates higher, not lower, even if headline rates fall. Now add one more pressure point. Central banks hold massive amounts of mortgage-backed securities. They bought them for years to keep the system liquid. They are now preparing to reduce those holdings. To do that, they must sell. When those assets hit the market, prices fall, yields rise, funding becomes more expensive. This drains liquidity from exactly the market that needs it most. So in the years ahead, commercial real estate faces a rare alignment: falling asset values, rising refinancing needs, shrinking credit supply. That alignment has appeared before. It never ends gently. People often ask who benefits from moments like this. The answer is uncomfortable: those with cash, those who waited, those who resisted the pressure to chase returns at the wrong time. Crises do not create wealth evenly. They redistribute it. That does not mean you should panic. It means you should pay attention. Protection comes before opportunity. Understanding cycles does not make you a pessimist. It makes you prepared. History does not repeat because humans are foolish. It repeats because incentives do not change. Debt amplifies confidence on the way up. It amplifies pain on the way down. The 18-year rhythm is not magic. It is memory, or the lack of it. The next part continues where this pressure leads. Who feels it next, and why timing matters more than prediction. Here is a moment in every cycle when the damage becomes visible, not to analysts. To ordinary people, it usually starts with small things. A familiar cafe closes. A quiet office building never turns its lights back on. A local bank branch shortens its hours. None of these feel like a crisis. They feel like coincidence, but beneath them is the same force: cash flow disappearing faster than debt can adjust. When banks stop lending, the economy does not freeze instantly. It slows unevenly, like a machine losing oil. Small businesses feel it first. They rely on short-term credit, inventory lines, expansion loans, working capital. When those vanish, hiring stops. Then hours are cut. Then jobs disappear. This is how financial stress becomes social stress. Unemployment does not spike because people forgot how to work. It rises because capital stopped moving. Commercial real estate is deeply connected to this process, not emotionally, mechanically. Office buildings support entire ecosystems. Cleaning crews, security, maintenance, cafes, transport. When occupancy collapses, those jobs fade quietly. One by one, cities begin to hollow out, not dramatically, gradually. Tax revenue shrinks. Municipal budgets tighten, public services degrade, governments respond the only way they can. They cut spending. This is why economic downturns feel synchronized even across countries. Capital moves globally, confidence moves faster. Many people believe this only matters if they own property or work in finance. That belief has always been wrong. During the last crisis, people across Asia and Europe lost jobs without ever touching a US mortgage. Their companies depended on global demand, global credit, global confidence. When one pillar collapses, the tremor travels. Another illusion appears at this stage: the idea that falling interest rates will save the system. Rate cuts help liquidity at the margins. They do not repair broken balance sheets. If an asset lost 40% of its value, cheaper interest does not restore that value. If a borrower borrows more than the property is worth, lower rates do not change the math. This is why cycles do not end the moment central banks pivot. They end when bad debt clears. That clearing is painful, but it is necessary. Assets change hands, prices reset, capital finds stronger foundations. This is the part few people emotionally accept. They want stability without loss, growth without risk. Markets do not work that way. Every period of excess must be followed by restraint. Every illusion of safety eventually meets reality. This does not mean disaster is guaranteed tomorrow. It means probability is rising. And probability rewards preparation. The goal is not to predict the exact moment. It is to avoid being forced into decisions when choices disappear. Liquidity is not about opportunity, it is about control. When others must sell, choice belongs to the buyer. History shows this clearly. Those who preserved capital during downturns gained leverage afterward. Not financial leverage, strategic leverage. They could wait, they could choose. Those who ignored cycles paid with stress, lost time, and lost freedom. The pattern is not moral. It does not punish or reward virtue. It responds to structure. Debt cycles unwind when refinancing fails. Commercial real estate sits at the center of that process today. That does not mean everything collapses. It means the system sheds weight. Understanding this is not about fear. It is about clarity. Most people are not late because they lacked intelligence. They were late because they trusted stability to last forever. This is why attention matters more than prediction. You do not need certainty to act wisely. You need awareness. Cycles do not ask for permission. They arrive when conditions align. The coming years will reward those who stayed flexible, those who resisted excess, those who valued resilience over speed. That has always been the quiet advantage. If there is one takeaway from this story, it is this. Cycles do not care about opinions. They respond to structure, incentives, and memory. What you do with this information is what matters. You do not need to panic. You do not need to predict exact dates. You only need to stay aware and prepared. If this video helped you see the bigger picture more clearly, take a moment to like it. It helps this channel reach people who may need this perspective right now. Subscribe to the channel if you want to continue learning how money really moves through the system, especially during uncertain times. Leave a comment with your thoughts. Whether you agree or disagree, thoughtful discussion helps everyone sharpen their thinking. If someone you care about could benefit from this insight, share this video with them. In times of change, information can be a form of protection. Feel free to explore other videos on the channel if you want to go deeper into these ideas. And until next time, good luck, stay grounded, and I will see you in the next video.